What is capital structure? Capital structure is the foundation of a company's financials, a particular combination or mix of funding sources, which is debt and equity, that company will use to operate its overall operation and growth. Corporation capital structure describes how it raises capital for the operation. It is an important aspect for corporate finance as it affects the cost of capital, risk, and value of firm. It is important to make the right decision regarding the capital structure of the company in order to maximize its value, while considering the cost and benefit of each different types of financing in relation to firm values. Debt is a lower cost infinite to maturity capital source that legally binds the corporation to predictable cash outflow that need to refinance at an unknown cost at some point in the future. Equity, in the other hand, is a more expensive permanent source of financing with greater financial flexibility. Both debt and equity can be found on the balance sheet. Company assets also listed on the balance sheet are purchased with debt or equity. Capital structure can be a mixture of a company long-term debt, short-term debt, common stock, and preferred stock. A company proportion of short-term debt versus long-term debt is considered when analyzing its capital structure. Referring to a firm's debt to equity ratio that provided insight into how risky a company borrowing practice. That means the company that is heavily financed by debt has a more aggressive capital structure and therefore poses a greater risk to investors. Next, let's present how to determine the optimal capital structure. The optimal capital structure is estimated by calculating the mix of debt and equity that minimize the weighted average cost of capital (WACC) of a company while maximizing its market value. The lower the cost of capital, the greater the present value of the firm's future cash flow, discounted by the WACC. The optimal capital structure offers the company to be more capable to fund their operation with equity so they can minimize the company debt spending. In theory, debt financing generally offers the lowest cost of capital due to its tax deductibility. However, when determining the optimal capital structure, several factors come into. These include the company's business risk, its tax status, financial stability, management style, and market condition. For instance, a company with high business risk might option for a lower debt level in its capital structure to ensure it can meet its financial obligation. But in other hand, a company with a lot of tax shield might prefer equity financing over debt. This theory also plays an important role in determining the optimal capital structure. It is suggested by the trade-off theory that a combination of debt and financial distress can maximize the tax benefits of debt. While pecking order theory states that companies prioritize their source of financing, preferring internal funding first, then debt, and then equity as a last resort. Last but not least, using the weighted average cost of capital (WACC) or the cost of equity, companies can determine the optimal capital structure. Company WACC represent its debt cost and equity cost and indicate how much it will have to pay for capital in the long term. Determining the optimal capital structure involves balancing the benefits and drawbacks of debt and equity financing, managing risks, and minimizing the cost of capital and financial distress costs.
Next, I will tell you about the factors that affect capital structure and capital structure decision. The first one is cost of capital. Cost of capital is one of the important indicators which forecasts the expected return on investment a company must achieve in order to pay the project expenditure. This estimate serves as a safety net for a business, preventing it from selecting a capital structure that is above of the reasonable investment level and demands thoughtful decision making on project cost management. Fundamentally, a company's decision choice of capital structure between debt and equity is primarily influenced by the cost of capital, which causes the business to adjust and synchronize the financial plan accordingly. Finding the precise balance required to guarantee project profitability and the optimal investment choice. Next one is capital market condition. The capital structure decision of a corporation are heavily influenced by the condition of capital market, which include variables such as interest rate, investor mood, and also regulatory laws. Company decisions making between equity and debt funding are influenced by this factor, which also have an immediate effect on the availability and cost of financing alternative. Businesses can take the advantage of attractive conditions in a growing market to raise their money for investment or development. On the other hand, during the recession, businesses could place a higher priority on a capital protection and use more cautious financing technique. Investor preference are also influenced by the market perception of risk and return, which force the business to modify their capital structure in order to keep the investor trust. Companies can manage the changing of market condition and optimize their capital structure to maximize shareholder value by carefully timing capital rising and responding to regulatory changes. The last one is debt to equity ratio of a firm. The debt to equity ratio is an important indicator which offers an accurate assessment of a business capital structure requirement. A larger volume of loan capital can significantly affect the capital or equity structure's optimum balance. A low debt to equity ratio not only discourages stakeholder investment, but also reduces the company's reputation. On the other hand, a high debt to equity ratio demonstrates the strength and flexibility of the company's financial situation. Additionally, it facilitates a business access to.
Have you ever heard of financial distress? A company is said to be in financial distress when it is unable to generate enough revenue to meet its financial obligations. There are many causes to financial distress, which includes the company might have high fixed costs, illiquid assets, high debt, or other financial mismanagements. If the company is unable to control the situation, financial distress might. So, does this financial distress cause may harm the company in any way? I would say yes. However, is it the possibility to go bankrupt that actually bring a company's value down? Or is it the financial distress cost that actually play a big role in a firm's value? Let's find out together. Bankruptcy risk refers to the possibility that the company would make default, which may be caused by poor financial leverage, weak industry dynamics, and unfavorable economic conditions. This can affect the firm's value in terms of investors' perception and decision while they evaluating the financial health of the firm. Meanwhile, one of the financial distress costs, which is bankruptcy cost, incurred when the company undergoes a process of bankruptcy. Both direct bankruptcy costs such as legal fees, cost of asset liquidation, and indirect bankruptcy costs such as loss of employee morale and productivity, and many more, these costs add up fast, which the company has to bear. These costs are the one that actually bites off the firm's value. How this happened? Because other than settling all this financial obligation to the creditors, other than settling employees' wages, the company must also pay the cost of financial distress described earlier, which causes the declining value received by the company's shareholder and overall value of firm. Hence, it can be said that it is not the bankruptcy risk that lowers the value of firm, but rather the cost that comes in the process of bankruptcy that lowers the firm's value. Have you ever wondered how firm gets their funding to finance their business? Is it by debt? Is it by equity? Actually, firm can finance their business by both equity and debt. The good news is that if firm includes debt in their capital structuring, they are entitled for tax benefit because interest payment on loans are tax deductible, causing firm to pay less tax to the government. This will help the firm's value maximization. How is it possible that debt can increase firm value? Let's refer to the graph based on trade-off theory of capital structure. Based on the graph, VL represents the value of levered firms that finance their operation by both debt and equity. Hence, it has tax shield on the debt. On the other hand, VU is the value of the firm when it gets their financing from equity only. Hence, it has no tax shield. It can be seen that V, which is to represent the actual value of the firm, rises when the firm includes debt in their capital structuring to finance their business. The difference between VL and VU is the present value of the tax shield on debt. Meanwhile, the difference between VL and V is the financial distress cost. In order to achieve value maximization of a firm, the total value of the debt must be at optimal level, while the present value of the tax shield must still dominate and financial distress cost is small. Beyond that point, the tax shield is no longer beneficial as the level debt and financial distress cost has dominates, causing the firm value to decline. Hence, in order to maximize a firm value, financial managers should allow an optimal level of debt as this will give a tax advantage for the firm and help the firm to reach value maximization, yet they have to control the debt to not let the probability of financial distress cost dominate the value of the firm. Now, we shall move to the next part.
Hai, Assalamualaikum warahmatullahi wabarakatuh. My name is NURASHIKIN with TUGIRIN. My matrix ID number is 202333654X7. I will continue this video presentation with my part which is agency of equity. Alright, do you know what is the definition of agency of equity? It's okay, let me explain. Okay, from my perception, agency of equity refers to conflicts of interest between the management of a company and its shareholders. Equity typically arises in the wake of core inefficiencies, dissatisfactions, and disruptions such as conflicts of interest between shareholders and management. The payment of the agency cost is to acting agent. Agency costs are further subdivided into direct and also indirect agency costs. For direct agency costs, there are expenses associated with resolving disagreements and managing the relationship between shareholders and also management. While for indirect agency costs, it represents lost opportunities such as when shareholders want to undertake a project that will increase the stock value, but the management team is afraid of potential risk and does not take on the project, resulting in a missed opportunity for shareholders. Let's talk about the component of agency of equity. There are three components of agency of equity, which is firstly, it is monitoring costs. It pertains to the financial expenditures and exertions undertaken by the owner or principal to actively supervise and evaluate the activity choices and performance of the management team within the company. Secondly, for binding costs, it encompasses the expenditures incurred by management in their endeavors to establish reliable assurance to owners and shareholders regarding the adherence to the owner's utmost interests. Lastly, for the components of agency of equity, it is a residual losses. What is residual losses? Residual losses is and expenses accrued even in the presence of meticulous implementation. Alright guys, let's move on to the next.
Assalamualaikum warahmatullahi wabarakatuh. My name is AZZA BUSSAINA binti Muhammad SHAKIR, and I will continue this presentation by explaining about pecking order theory for businesses. Making profit from sales are important, but they also try to raise money from external investors and lenders. However, how much of each type of security should be offered to investor and debt holder? This fundamental business topic is analyzed by capital structure theory, but what is the pecking order theory? Asymmetric information is the theoretical basis for the pecking order. When one party has access to more or better information than the other, a situation known as asymmetric information or information failure exists. This occurrence resulted in the establishment of hierarchical structure known as the pecking order theory of capital structure, which argues that companies should prioritize the utilization of the most accessible sources of funding to meet their financial requirements. Based on the theoretical framework, it is suggested that the initial sources of funding needs to be derived from internal resources. Typically, this represents the retained earning in situation when organizations have limitation in generating sufficient cash through internal financing. It is advisable for them to consider debt financing as the subsequent choice. If further funds are still necessary, equity financing can be considered as the third alternative. In summary, it is advisable for companies to consider utilizing equity as a means of financing only as a final option. The forming of a pecking order holds significance as it serves as an indicator to general public of the company's performance. When a corporation relies on internal financing, it signifies that its financial strength is derived from its own resources, hence reducing the presence of information asymmetry. If a firm chooses to fund its operation through debt, it might be seen as an indication that the management team possesses a certain level of confidence in the company's ability to fulfill its monthly financial commitments. When a firm chooses to finance itself by issuing new stock, it is often perceived as a negative signal. This is because it implies that the company believes its stock is now overvalued and it aims to generate funds before the potential decline in its share price. The implications of the pecking orders are: first, firms prefer internal financing; second, adapt target dividend payout ratios to investment possibilities while avoiding dividend adjustment; third, internally generated cash flow are occasionally greater than capital expenditures, but not always. This is because of dividend policy as well as changes in profitability and investment prospect. If the amount is more, the company pays down debt or invests in marketable securities. If it is lesser, the firm first reduces its cash balance or sells marketable securities. Fourth, if external financing is required, firm initially issue the safety security, that is, they begin with debt that maybe would securities such as convertible bonds and last option equity. Because there are two different types of equity in this model, which are internal and external, there is no clearly defined optimal debt equity combination. The pecking order explains why the most successful businesses borrow the least amount of money. That is not because their goal debt ratio is low, but because they don't need it. Because debt financing is at the top of the external financing pecking order. These profitability corporations are more likely to issue debt when they lack the internal resources to support their capital expenditure programs. Position at the top of the pecking order has several advantages over lower ranks. That is why it's important to have financials like financial laxity is characterized by the possession of liquid assets such as cash, marketable securities, and real estate, as well as easy access to debt markets or bank financing. As a result, businesses seek to ensure that they have enough financial slack so that funding for smart investment is readily available. A study discovered that the debt ratio of individual enterprise appeared to be influenced by four major elements demonstrating the pecking order evidence. First, size. Bigger firms have larger debt to equity ratio. Second, tangible asset. Firms with high fixed asset to total asset ratio have higher debt levels. Three, profitability. Debt ratio are lower in more profitable companies. Lastly, market to book. Firms with higher market to book value ratio have lower debt ratio. That's all for me.
Let's move on to the next topic, which is signaling hypothesis. As you guys know, what is signaling hypothesis? The signaling hypothesis proposes that action or decisions made by a company's management that can provide the market with insight into the company's status and future outlook. According to this theory, CEOs and board members have insight into the company that the public may not have. Their decision could communicate important information to investors about the company's performance and future prospects. When the cost of borrowing money matches the incentives for doing so, a company's mix of funding is considered ideal. Investors see taking on debt as a measure of a company value. Businesses with profit margins tend to keep their debt level low well. On the other hand, companies expecting substantial profit by options notes, a method who overly relies on borrowing to deceive investors will face consequences in time. Alright, from this signaling hypothesis, we can conclude the idea of signaling in finance often connects with how companies handle the dividends. When a company decides to increase dividends, investors might interpret it as a sign that the management confident about the company's future growth and profitability. That's all from my part. Thank you for your time and listen to our video presentation. Thank you.